For all of our savvy listeners, at some point in your life, believe me, you will have a big pile of cash. It might be your emergency fund, or it might be earmarked for college tuition or a mortgage. And if you need to access it in the next 3 to 5 years, you do not want it in the stock market. It's painful to look at a huge pile of cash and just see it sitting there and not growing, especially since the interest rate in your savings account is pretty much mathematically close to zero as it can get. So where can you put it? Pro is here with some options.
Yay!
Yay! All right, first, did I miss anything as far as why people typically have massive piles of cash?
No, those are the big reasons. Number one, the emergency fund. And we're talking like in case there's an unexpected big ticket expense, your roof collapses or your car goes completely kaput, something like that. You lose your job. You need to have some money to live off of. And the rule of thumb on that is 3 to 6 months of required expenses. But if you're single or married with no kids, you don't have a mortgage, you can play it pretty safe in terms of your emergency fund. It can be pretty small. If you have kids, if you have a mortgage, if you have a job where you're not so sure about your security, maybe you should have a bigger emergency fund. So that's one. The other one is money you need in the next 2 to 5 years. Could be to buy a house, could be to buy a car, could be because your kid's in college. And the reason why you wouldn't put it in the stock market, well, the stock market, as you may have heard, goes down every once in a while.
No.
Yes.
I only believe in stock markets that go up.
It's the truth. And according to a research from American Funds, they looked at the stock market from 1900 to the end of 2014. Roughly speaking, the market goes down 10% about once a year, and it goes down 15% or more about once every 2 years. So you're looking at a situation where it can recover. If you look at it on a calendar year basis, the market is down about once every 4 years. But when it goes down, it can be significant. And I've told the story before about a fellow I know who had all his daughter's college money in the stock market. She was a senior in high school. 2000 happens, and half the money goes away. Brutal. So you got to have it nice and safe. But that doesn't mean you have to earn nothing. And if you look at the average interest rate on a checking account these days, it literally is 0.01. It's nothing. But if you put in a little bit more effort, you can get a little bit higher interest rate. So I looked at NerdWallet and Bankrate to see what's available out there. And it depends on where you live. So because some banks are licensed to operate in your area or not. But generally speaking, if you're going for a high yield savings rate, you can get close to 1%. A 1-year CD, 1.25%, and all on the way up to a 5-year CD of 2%.
This is where I need to ask a little embarrassing question.
Sure.
But I don't really know what a CD is.
So a CD is a certificate of deposit.
Right.
And the reason why they yield a little extra return is because you're locking that money up. So if you buy a 3-year CD and you can get a rate of about 1.5% on that, you have to plan on leaving that money there. That doesn't necessarily mean you can't get it, but you'll probably pay a penalty of like 3 months interest or something like that if you have to touch it. So
basically it's just setting money aside with your bank. And your bank's like, I'm going to take this and I'm going to have some fun with your money. You don't get it.
Right.
Until you cash it in again when it expires. Kind of like a bond.
Right. It's exactly like a bond.
Oh, it's exactly like a bond.
Because that's what you're lending the money to the bank, and the bank turns around and lends it to other folks at a slightly higher rate. And the good thing about a CD is to consider, it's a good option if you have a certain known expense. So let's say you have that senior in high school and you have a certain amount set away for college. You can buy a 1-year, 2-year, 3-year, 4-year CD. So every year, right before you have to pay that tuition bill, some of that money comes due. And by locking up some of that longer term money, you can earn a little bit of extra interest.
But you can still cash it in a case of an emergency.
It depends. You have to look at the terms of the bank that's offering the CD. And the other good thing about these high yield savings accounts and CDs is that they're FDIC insured, which makes people feel pretty good. And there's actually more insurance available than people think. The limit is $250,000 per account per title. So you could have up to that amount in a single account at a bank, and then a whole other amount if you have a joint account, and a whole other amount if you have like an IRA CD. There's actually, you can go to the FDIC's website. It's fdic.gov/EDI, which stands for your electronic deposit insurance estimator. You put in your banks and your different accounts. It'll tell you how much of your deposits are insured. So it's pretty easy to get enough FDIC insurance. So that's all pretty attractive stuff, but let's talk about some of the other alternatives that people look at. One thing that people look at in terms of cash are what they'll just say money markets. And one thing that people don't understand is the difference between money market accounts and money market funds. Money market accounts are offered by banks. They are FDIC insured. They're usually a little higher interest rate than a normal savings account, but you don't have as much access to the money. So the bank might say, we're going to pay you a little extra than on a normal checking or savings account, but you can only write 3 checks on it every month.
Okay, yeah.
So you have to be willing to lock it up. Money market fund is offered by mutual fund companies. They are not FDIC insured. They might have a slightly higher interest rate, except that starting in October of this year, there are going to be new rules about money market funds based on what happened in 2008. Money market funds, the attraction of those has always been that they have a net asset value, a price of $1. So you know what it's worth. It's always worth $1 per share. In the financial crisis of 2008, one of the bigger funds, what they called broke the buck. They could no longer offer it as $1, and they had to limit redemptions. And up to 20 other mutual money market funds came close to doing that. So since then, the SEC has come up with new rules that take effect in this October that basically say some types of money market funds will fluctuate in value. It may not be $1 per share. Also, during times of economic stress, they may charge redemption fees, and they may limit your access to the money. Because the problem with the one fund that broke the buck was everyone called in and said, I want my money back.
Bank run, huh?
So if you have a money market fund, and it might be in your brokerage account, and that's your cash equivalent, it might be the cash option in your 401k or 403b, you need to find out what the new rule is going to be on that fund, because it's going to be very different for many of these funds.
So you're talking a lot about making sure things are FDIC insured, but seriously, how much do I have to worry about that? Like, when was the last time my little bank of when was the last time a bank had to draw on that insurance? Is that common?
Yes. I mean, part of it is, so that FDIC insurance all came out of the Great Depression. We all remember that It's a Wonderful Life, right? When everyone ran on the bank and wanted their money back, and George Bailey pointed out, like, I don't have the money here. It's in this person's house and this person's house. So they created FDIC insurance as a certain degree of peace of mind, so that everyone wouldn't run to the bank and take their money out. So part of it is psychological. But in the 80s, during the savings and loans crisis, many big banks went under. And if it weren't for the extraordinary efforts of the Federal Reserve and other branches of the government, more banks during the Great Recession would have gone under. So it's important to have. It's you are right to point out that generally speaking, it's not like your local bank is going to, goes out kind of business on a regular basis. And frankly, also, most people don't have more than $250,000 lying around in cash. But it does help people feel secure about their money.